Hello kings and queens of forex trading, welcome back to our Babypips course for today. And just a quick overview of what we have done so far. We have completed course 1 preschool. We are done with kindergarten also as well. Elementary completed, middle school completed, summer school was done already, high school course 6 is also done. And today we'll continue from course 7. And once we finish course 7, we'll be having just courses left for us to go, completing baby school. If you have completed the courses from course 1 to this level, congratulations, you are making progress. Okay, so what do we have in course 7? The outline is market sentiment, trading the news, carry trade. And under market sentiment, here are the subtopics. Market sentiment, commitment of traders report, very important. How to find the COT report, understanding the COT report, how to use the COT report for trading, and then how to pick tops and bottoms with the COT report, how to create your own COT trading indicator, how to interpret the COT report, summary of market sentiment. And now that's our outline for undergraduate freshman. Okay, so let us quickly discuss what market sentiment is by considering the first one that says market sentiment. But before I open the link in the new tab, please let somebody just roll the intro for us. So roll the intro, buddy. So traders, this is going to be really quick. Market sentiment, how the market's feeling, how Mr. Market is feeling. Okay, now because the forex market is terribly decentralized, okay, we cannot really gauge the volatility of the market. We can't say this is how it is or that is how it is. And how you feel about the market is not the same way somebody else feels about the market. You might be thinking, well, we are in a bullish environment. Somebody else also might be thinking, well, we are in a bearish environment. And this is all about sentiment. Okay, this is what sentiment is all about. The feelings of participants, of every participant in the market, their ideas, their thoughts, their opinions, all of them combined together is what we mean by saying market sentiment. Okay, so how do you develop a market sentiment based approach while you are about to trade the market? Many of traders do this by using indicators. They study the candles, they do a whole lot of stuff, support and resistance, technical analysis, fundamental analysis. They try to bring everything they have learned, okay, to try to understand the sentiment of the market, either bullish or bearish, up or down, support and resistance, what have you, all that. They do that, and it's not bad if you do that, but we really cannot gauge the volatility of the market. Why? Because we don't have volume. Okay, if it's in stock market, we can say, okay, what is the volume of the market today? We know the volume of the market. Okay, that's the direction of the market is going to go, up or down, and then we'll go ahead. But in forex market, because it is decentralized and we cannot gauge volatility, we do not have anything called volume, only volatility. Okay, it becomes really difficult. So without volume, how can a forex trader measure market sentiment? This is where commitment of traders report comes in. So let's move to the next lesson to see what commitment of traders report is all about. The Commodity Futures Trading Commission, or CFTC, publishes the commitment of traders report every Friday around 2:30 p.m. Eastern Time. Now, because the COT measures the long and short positions taken by speculative traders and commercial traders, it is a great resource to gauge how heavily these market players are positioned in the market. Now, just like a team of market players, these hedgers, large speculators and retail traders, they all have their role in the market. And so we are going to use the commitment of traders report to know which particular role they are playing. Okay, so you might be asking, doesn't the spot market have a report that measures how currency traders are positioned? Actually, no. Remember, it is because the spot forex is traded over the counter. transactions do not pass through a centralized exchange like the Chicago Mercantile Exchange. So the closest way we can get our hands to see what the statement of the market and how the big players are moving their money is through the commitment of traders report. Okay, so before we dive into how the commitment of traders report is being used by forex trader, you have to first know where to go to get the COT report. Okay, now take this seriously, because the COT report will give you an idea, will tell you what the big players, those who are making the moves in the forex market, what they are doing. It's like behind closed door meeting. Okay, not many people know this information I'm sharing with you now. Not many people know this. They do not know. All they know is support and resistance and all that, right? They do not know how to position themselves behind the big players in the market. So first, let's go to how to find the COT report, next lesson. So here we are on how to find the COT report. Step 1 says open up the address below in your web browser. So here is the address, okay? And I'm clicking on it and it's going to open up. So here's the CFTC, Commodity Futures Trading Commission. Okay, now because the link is here already, it makes it easy. So let's say we want to go without, you're on your computer right now, you can click on CFTC, commodity and all that. So what you do on Google, you just type CFTC, okay, and let it open up. And so here you are, Commodity Futures Trading Commission, and you click on the first one, and here it is. And then let's move on to the next instruction, what we have to do. Step 2 says once the page has loaded, scroll down a couple of pages to the current legacy report. So let's go look for current legacy report. Where is it? Current legacy report is not here. Okay, it is here, but you do not know where it is. So come to this tab, market data and economic analysis. You see data as CFTC, and then you see commitment of traders. Click. And so I have clicked and it has opened this page again. So let us go back and look at here. So it says scroll down a couple of pages to the current legacy report. Okay, so let's go look for the current legacy report. Current legacy report. Where is it? Where is it? Current legacy report, right? Okay, let's go back again now and click on short format under futures only on the Chicago Mercantile Exchange row to access the most recent COT report. So we have to click on short format under futures only, okay, on the Chicago Mercantile Exchange here. So we have Chicago Mercantile Exchange, we have the futures only here, and here is the short format. So we have to click on short format, and it said when we click on short format, we will have access to the most recent COT report. So let's go back. We've clicked on it. Oh, voila, here is it. This is the COT report, the reportage of the hedge funds, of the speculators, and of retail traders. Now we have come behind the closed door meeting. So this is what they do. This is how to find all the information. Oh, good. Now we can trade like the big boys. Now step 3 says it may seem a little intimidating at first because it looks like a big giant gobble up block, and now step 3 says it may seem a little intimidating at first because it looks like a big giant gobble up block of text, but with a little bit of effort you can find exactly what you're looking for. So just press Ctrl F, and find whatever you want to find. So to find British pound sterling or GBP, for example, what you have to do is press Ctrl F and type in GBP. Okay, let's go down to see. Okay, here is the explanation. Okay, but before we come back to this, before we explain this, do this explanation, let's go and look for GBP. So we are told to press Ctrl F and here you have the Control F find, and let's type GBP. Voila, yeah, here it is, GBP. Okay, and so this is British Pound Sterling, Chicago Mercantile Exchange. Now we have non-commercials, we have commercial, we have total, we have long short and spreads, we have long short, we have long short under total. Okay, so let's go back to Baby Pips and see how we are to understand this. Okay, we are definitely going to read. I'm not going to explain and do all the talking and all that. No, we are going to read word for word. Okay, so commercials. What is commercials? Oh my goodness, where are you? Okay, yes, this is what I did. I was trying to separate it. So commercials, which we have here. Okay, so this is commercials. Now it says, let me put this like this side by side. Let me make this bigger a little bit. I told you we can't hurry this section, so you have to pay attention to what we're doing, because it is very, very important, my friends, kings and queens of forex trading. Okay, so yeah, I think we're good to go. Let me log this in a little bit. Yeah, okay, good. So what is commercials? Okay, so we can look at the screen side by side and learn. Now, commercials, these are the big businesses that use currency futures to hedge and protect themselves from too much exchange rate fluctuation. So here are the commercials. Okay, people in this category, they are the ones who use currency futures to hedge themselves and protect themselves from too much exchange rate. Now, what about non-commercials? This is a mixture of individual traders, hedge funds, and financial institutions. For the most part, these are traders who are looking to trade for speculative gains. In other words, these are traders just like you who are in it for the Benjamins. Okay, you fall under this category of non-commercials. Okay, not just you alone, but here are the other big boys in this category. Even if we are in this level, here are the big boys: the hedge funds, the financial institutions. Okay, they are the big boys in this area. Here, they're the ones who control these non-commercials, not you. No, you are here, your trades are here. Okay, let me ask you a question. Your trades that you're going to take for next week, are you sure the amount of money you want to put in for trades for next week or this week or whatever trade you are on right now, do you think they have gotten the information about your trades, your positions for this week under this non-commercial? No, but your own trade is there. Okay, I'll explain further how your trades is there. Okay, now here are the non-commercials: the hedge funds, the individual traders, and financial institutions. But pay attention to financial institutions, hedge funds, and also your trades are here. Okay, now next we have long. That's the number of long contracts reported to the CFTC. The number of long contracts they have reported. Okay, here are the long positions. Okay, we are buying long. Okay, the number of people who have given us their contracts, okay, they are buying long positions. They are long for GBP USD. These are the number of contracts they have. Now shorts, that's the number of short contracts reported to the CFTC. Here it is. Short. Okay, we are going short on this pair. How many shorts do we have? 27360. And for long for this week we have 61271. Now open interest. This column represents the number of contracts out there that have not been exercised or delivered. That's open interest. Where is the open interest? Here you go, at 38% of contracts for the long positions not yet delivered, 15% for short not yet delivered. This is the spread 2.7. okay, these contracts have not yet been delivered. Now, number of traders, this is the total number of traders who are required to report positions to the CFTC. Here for the long, 32, 34 rather, for the short, 22 number of traders in total. Okay, and spreads, here they are. Now, so reportable positions, the number of options and futures positions that are required to be reported according to the CFTC regulations. Okay, so here is reportable positions. Here, reportable positions, reportable. Do you see reportable positions? No. Okay, there is no column like that. However, here are the reportable positions. They've been stated already. Okay, so all these figures, they have been reported already. The long, short, they are required. These are the positions. Okay, now we have non-reportable positions, the number of open interest positions that do not meet the reportable requirements of the CFTC, like retail traders. So here are the non-reportable positions. They do not meet the requirement of the CFTC for those positions to be reported. So if you want to access all available historical data, you can view it here. You can see a lot of things in the COT report, but you don't have to memorize all of it. As a budding trader, you will only be focusing on answering the basic question: what that daily on the market, yo? It means, what's the market feeling like this week? So, having explained in summary what the CFTC COT report means, now it is time for us to move to the next lesson, where we are going to understand the COT report. So I think I can close this now. Should I close the? Okay, let's go further to understand the COT report. Okay, so how are we going to understand the COT report? In order for you to understand the futures market, you need to know the big boys and the big boys. Okay, know the big boys and the big boys. Then you also need to know those who are just bench warmers. Okay, so who are the major players and who are they? Now, these players can be categorized into 3 categories. The first one is commercial traders, non-commercial traders, retail traders. Now, commercial traders are hedgers, non-commercial traders are large speculators, retail traders are small speculators. Okay, now don't ignore the commercial traders. Hedgers or commercial traders are those who want to protect themselves against unexpected price movement. Now, agricultural producers or farmers who want to hedge, which means to minimize their risk in changing commodity prices, they are part of this group. Okay, now banks or corporations who are looking to protect themselves against sudden price changes in currencies or other assets are also considered commercial traders. Now, a key characteristic of hedgers is that they are most bullish at market bottoms and most bearish at market tops. I hope you get that correctly. A key characteristic of hedgers is that they are most bullish at market bottoms and most bearish at market tops. So let's go by this illustration that we have here. Let's say, for example, there's a virus outbreak in the United States and people are turning into zombies. What are these zombies doing? They are grabbing people's iPhones and downloading malicious softwares, or they are downloading fat apps. Funny, right? And so there's total mayhem. People are disoriented, people are helpless, they are losing their phones, everything is rampant, zombies are everywhere, guns don't even kill them. The only way to kill them is to chop off their heads by buying swords. So a company wants to buy swords that they can use to chop off the heads of these zombies. And which company can this be other than Apple? So Apple sees a market need and decides to build a private samurai army to protect vulnerable iPhone users. Now it needs to import samurai swords from Japan. Now the owner of, or the CEO of Apple, Tim Cook, enters a contract with a Japanese samurai swordsmith. Now the samurai swordsmith decides to be paid for his services in Japanese yen when he finishes the production of the sword, and that's just after 3 months. And so what does Apple do? Apple then decides to buy Japanese yen, okay, because it's not going to be able to pay the the swordsmith in US dollar. The swordsmith demands to be paid in Japanese yen. He's in Japan. He can only use Japanese yen to do business over there. He's not in the United States, so the US dollar is of no value to him. So Apple is going to pay in Japanese yen. So after 3 months of finishing the contract, so what is Apple going to do? Tim Cook decides to say, okay, I am going to protect myself. I am going to hedge myself so that in 3 months time, okay, I will not be in too much loss or too much gain. Why? Because currency, the price of the Japanese, the US dollar after 3 months time might drop, decrease in value, and the Japanese yen might increase in value. So, and besides, I'm moving billions or millions of dollars converted into Japanese yen to Japan for this my colleague, my business contact over there. So what does he do? Tim Cook decides to buy JPY futures. Let's write this here. He decides to buy JPY, Japanese yen futures. Okay, yes, futures. There you go. So in order to protect himself, or rather hedge against currency risk, the firm buys JPY futures. Now what will happen? He is in the United States, okay? He's in the US. Now this is the business. This is understand hedging. We're trying to understand hedging and what the hedgers do, okay? So if the USD JPY falls after 3 months, the firm's gain, remember, Apple, let me write this here, okay, or let's use the name Tim. Let's use Tim Cook, okay, let's say Mr. Tim here. He decides to buy JPY futures, okay, futures in 3 months, because he's going to pay the Japanese swordsmith, okay, in 3 months. So he decides to buy JPY futures, not FCT, not currencies on the spot trading. He decides to buy futures, okay. If the USD JPY falls after 3 months, the gains on the futures contract would offset the increased cost of transaction with the Japanese swordsmith, okay. If this one falls down, it is no longer in value, okay. However, in the futures this way, because it's falling here in the spot, in the futures this way, JPY is going to rise. And remember, he didn't sell the JPY futures, he bought the JPY futures. So he's going to make profits here. He's going to bank in dollars here, okay, in the JPY futures that he bought. Do you understand? He bought JPY futures. Now, if price here, USD JPY, okay, if USD JPY falls, okay, price is going down, he's going to make profits in JPY futures. So either way, he's a winner. The price is dropping here, but he's making profit there. He's a winner. Do you understand? That is what hedging or hedgers they do, okay. Now on the other hand, if the USD JPY rises after 3 months, the firm's loss on the futures contract would be offset by the decrease in cost of its payment for the samurai swords. Now, if he loses here, okay, remember he bought JPY futures. Now, after 3 months, price came down instead of going up. Price of the JPY futures came down. He's now negative in dollars here. Okay, remember,
incoming mail.
On the other side, USD JPY this way, okay, the price will rise against the JPY. So the amount of money he is going to pay here would be less, because the value here for the USD JPY has increased greatly.
Incoming mail.
And this also will be able to offset the losses here. So that is how hedgers, they make sure that commodity prices protect them against whatever is going on in the foreign exchange market. So this is what hedgers usually do. Okay, so that's the position of hedgers. Now let's talk about large speculators. Remember, we said we have 1, hedgers, we have 2, non-commercial traders. These are the institutions, these are the large speculators. Okay, now hedgers are those who are trading large commodity, people who are involved in milk, what is it called, cheese, what is it called, agricultural exports, huge, this and all that. They are especially on the hedging side. Now, non-commercial traders, these are the large speculators. So who are they? In contrast to hedgers, speculators are not interested in making profit from trading activities. Speculators are in it for the money and have no interest in owning the underlying assets. Now, many speculators are known as hardcore trend followers, since they buy when the market is in an uptrend and sell when the market is in a downtrend. They keep adding to their position until the price movement reverses. Large speculators are also big players in the futures market, since they hold huge accounts. As a result, their trading activities can cause the market to move dramatically. They usually follow moving averages and hold their positions until the trend changes. I hope you understand the large speculators. They usually follow moving averages and they hold their positions until the trend changes. Why are they able to hold large positions and follow huge moving averages? Because they are called large speculators, okay, in the futures market. And also they hold huge accounts. You can't imagine how much of financial instrument they control. Now, next on the list is the small speculators. The small speculators, on the other hand, own smaller retail accounts. These comprise of hedge funds and individual traders. They are known to be anti-trend and are usually on the wrong side of the market. Because of that, they are typically less successful than hedgers and commercial traders. However, when they do follow the trend, they tend to be highly concentrated at market tops or bottoms. Okay, so here are the 3 categories of people who are involved in the market, as we have seen in the CFTC reports. So next is how to use the COT report for trading. So traders, how to use the COT report. Since the COT report comes out every week, its usefulness as a market sentiment indicator will be more suitable for a longer term trades, not short term trades, longer term trades. Now the question you may be asking now is this: how do I know all those building blocks in here, how do I know all these stuffs that we talk about in this place? Okay, the report. Now, one way to be able to use these figures and know what they mean and what they stand for, one way to know them is by finding the extreme lows or extreme short positions, extreme net long or extreme short positions. Once you're able to find these positions combined with your COT report, okay, boom, you've made it. I've told you, you've made it. Trading forex becomes easy. It becomes non-mechanical. It becomes simple and very, very interesting. So finding these positions may signal that a market reversal is just around the corner, because if everyone is going long on the currency, nobody is left to buy. If everyone is going short, okay, no one is left to sell. Okay, so follow the direction of the big boys. Now let's look at an example here. From this example, we can see that something interesting just happened. Now look, and especially look at the timing. Okay, so let's first of all discuss what we have seen in the chart. In the chart here, we see the area of non-commercial traders, which is the blue line here. Okay, this upper part is price action. The bottom part, which is divided, the bottom divided part is the commitment of traders report. Okay, so from the chart we're looking at right now, we can see both the position of commercial traders, large or non-commercial traders, and the small or the small retail traders. Okay, and then we also have price action. So this top part here is price action, and this bottom part is the COT data. Here we have commercial traders and commercial traders is large speculators, and then we'll have small retail traders. Okay, the blue line is for commercial traders, the hedgers. Okay, the green line is for large speculators, and the red line is for small retail traders. Now if you take a look very closely, midway through 2008, you can see that Euro USD declined from July to September. Okay, so here is your Euro USD price, and see the decline. Look, this is July, September, the price drops. In the middle of September, net short positions hit an extreme high of 45,650, and soon after, investors started to buy back the Euro futures. So the net positions for during September hit extreme. Okay, that is, you're very, very low, and so investors started to buy back Euro futures again, Euro futures. Okay, for the future purpose. And what happened once they bought back Euro futures? Price started to rise steadily from 1.2400 to near high of 1.4700, and 4700 is around this level here. This is almost 4600 or 4700, around this area. Okay, so price got there because investors were buying euro, we're investing in Euro futures. Right now, as expected, eventually when they bought Euro futures, Euro USD price usually follow as well, because that's where the large speculators move to as well. So they buy when the trend is already on, so they bought as well, hitting an all-time new high of 1.5100. So in early October 2009, Euro futures net positions hit an extreme high of 51,000, and before it reversed sharply. And what happened as well, Euro USD began to decline as well. So once the price of the Euro USD, the investors from the futures, once future price hit an extreme high, okay, what happened? It was already in the overbought region, okay, and price started to reverse sharply, steadily from this level here down here. And if you look at price, the COT report as well, COT data, you see large speculators, okay, pushing prices down, selling it, and price action also went down. So if you had really followed this example, if you had followed through, you would have known that you would have caught a very huge amount of pips between mid 2009, September 2009, from here, this level, to down this level here. Here, this move. Okay, and here's another move as well. You would have caught lots of pips. I mean, like, you can't imagine how many pips that would have been. That would have amounted to over 1500 pips for you. 1500 pips, okay, for you. So with those two moves, you can see that using the COT report as a market sentiment reversal indicator, you would have grabbed lots of pips. So practice how to use the COT report as a market sentiment reversal indicator. In that way, you'll be able to make maximum profit from mastering the how to use the COT report. So the first move was 2000 pips, and the second move was 1500 pips. This is 1 and this is 2, and this will give you 3500. Okay, so I hope that is very well understood. With that, let's move to the next lesson that says how to pick tops and bottoms with the COT report. So how do we pick tops and bottoms with the COT report? As you have guessed, the ideal places to go for shorts and longs, okay, at times like this when it comes to sentiment report is at the extreme. While hedgers buy when the market is bottoming, speculators sell as the price comes down. Hedgers, they buy when the market bottoms out. Okay, here's hedgers. However, speculators, they sell in the process of price bottoming out. Okay, I hope you are able to understand that. So you have to look for extremes where price is failing to break, because what is happening there most of the times, it is likely that hedgers are in this area buying the currency. Speculators have, on the other hand, sold the currency down to this place. So hedgers come and they buy. As you can see from the diagram here, the green line is the hedgers, okay, and the blue line is the speculators. See, they are always going apart. So that's the chart there. Hedgers are bearish when the market moves to the top, while speculators are bullish when price is climbing. Understand that again. Hedgers are bearish when market moves to the top. On the other hand, speculators are bullish when price is climbing up. So as a result, speculative positioning indicates trend direction, while commercial positioning could signal price reversals. Okay, so you can use both hand in hand. If hedgers keep increasing their long positions while speculators increase their short positions, a market bottom could be in sight. If hedgers increase their long positions while speculators increase their short positions, okay, a market bottom could be in sight, because hedgers are the one buying for the future. And so if speculators are selling whereas hedgers are buying, it shows that the market bottom, okay, a strong reversal is in sight. Now if hedgers keep adding more short positions while speculators keep adding more long positions, a market top could occur. Hedgers are shorting the pair, but speculators are increasing buy positions. It shows that a market top is in sight. A huge reversal from the top side is imminent. Okay, now it is difficult to determine the exact point where a sentiment extreme will occur, so it is best to do nothing until signs of actual reversals, because we could say that speculators, because they follow the trend, catch most of the move but are wrong on turning points. Commercial traders, on the other hand, miss most of the trend except when price reverses. Until a sentiment extreme occurs, it would be best to go with the speculators. Now the best route to do this, to trade with the COT report, is this: every market top or bottom is accompanied by a sentiment extreme. but not every sentiment extreme results in the market top or bottom. So how do you create your own trading, your own COT trading indicator? Next lesson. So here we are, how to create your own COT trading indicator. Now basically what this page is telling us, especially the top side here, is that what works a goal. Like if you see a figure COT report, don't just jump quickly in like say, aha, this is a market top or market bottom, it's right to sell or it's time to buy. No, don't do that. Why? Because what may appear to be a extreme level 5 years ago may no longer be an extreme level this year. So how do you deal with this? You have to create an index that measures market extremes. Now here's a step-by-step process on how to do that. Decide how long of a period we want to cover. The more values we input into the index, the less sentiment extreme signals we will receive, but the more reliable it will be. So having fewer input values will result in more signals, although it might lead to more false positives. Then calculate the difference between the positions of large speculators and commercial traders for each week. The formula for calculating this difference is this. The difference is the net positions of large speculators minus net positions of commercials. Take note that if large speculators are extremely long, this implies that commercial traders are extremely short. Now this would result in a positive figure. On the other hand, if large speculators are extremely short, that would mean that commercial traders are most likely extremely long. This will result in a negative figure. Okay. 1. Rank these results in ascending order from most negative to most positive. Assign a value of 100 to the largest number and 0 to the smallest. And now that we have our COT indicator, yes, we are good to go. Now this is very similar to the RSI and stochastic indicator that we've discussed earlier. So once we have assigned these values to each of the calculated differences, we should be alerted whenever a new data imputed into the index shows an extreme 0 or 100. This will indicate that the difference between the positions of the two groups is largest and that reversal may be imminent. Remember, we are interested in knowing whether the trend is going to continue or if it's going to end. If the COT report reveals that the markets are at extreme levels, it would help pinpoint those tops and bottoms that we all love so much. You can download the COT indicator if you are trading on MT4, and you can find a link in our COT data to indicator forum trade here. Now I know I must have made this thing simple for us to go through, okay, but here is what I want you to do. Come back and study this again. If you want to go through this whole chapter again, do it. If you want to go to Babypips and read it on your own, do it. Don't rush this, okay? I don't want you to rush this on your own, okay? Do this. This is hard work. Calculating these figures, okay, here is hard work. But once you can get it right and first time, and once it is done correctly, you are good to go, okay? So let's move to the next lesson that says how to interpret the COT reports. Now that you know how to determine the sentiment extremes, it is now left for us to be able to determine how to calculate the indicator very well. Recall that not every sentiment extreme results in a market bottom, so we will need more accurate indicator. Calculating the percentage of speculative positions that are long or short will be better gauge to see whether the market is topping or bottoming out. Now the equation for calculating the long or short is indicated below. Let's take a look. Here it is. The percentage long equals to the percentage of long contrast divided by the percentage of long contracts plus the percentage of short contracts. Now for short is equal to the percentage of short contracts divided by the percentage of long contracts plus the percentage of short contracts. Okay, now to illustrate this, let's see what happened to the Canadian dollar. As at 2008, speculators, the CO2 reports shows that speculators were net short 28,085 contracts, and on March 2009 they were net short 23,950 contracts. Now, from the information above you have seen, you agree that there is higher probability of the market to bottom out in August, since there were more speculators that were net short in that period. But what do we have? Even though there were more short in the month of August compared to more net short in March 2019, say August, 28,000, okay? More people on the short. Now look at what happened. Here we go. See what happened. There are more net short here of people in this month, okay? Because of this, capacity, you might be thinking, okay, maybe the market has, bottomed out, but it didn't happen. That was not the bottom of the market. Even though there are many people who were short on the currency, it wasn't the bottom. Price continued to fall down. Even though it was, finding support here, it finally broke support and continued to fall down. It wasn't the bottom of the market. I hope you understand that. Now, a closer look will show that 66,726 contracts were short, while 38,641 contracts were long. Now, out of all the speculative positions in August, we had 66,726 divided by 38,641 plus 66,726, and that gives us 63.3% net short positions. On the other hand, during March of 2009, there were just 8,715 long contracts and 32,665 short contracts in March. So what is the calculation? This means that 32,000, okay, divided by 8,715 plus 32,665, that gives us 78.9% of the speculative positions were short positions during that period. What does that mean? There is a higher chance that the market will occur, that the bottom will occur, when 78.9% of all speculative positions are short, as opposed to just 63%. So as you can see on the chart above here, we have the short ratio here, which was 78.9 positions of people short. And what happened? When they were net short, the commercials came in, bought the market. And what happened? Price moved to the other side. So, the bottoming out did not occur when it was anticipated here. Not here, even though there are many short positions here, 63%. It occurred when it was 78%. Okay? I don't know if you are understanding what we are discussing so far. So, the chart shows that the market did not bottom out during August 2008 when the Canadian dollar was just roughly around 94 cents. The Canadian dollar continued to fall. But by the time the market came around and the short ratio hit 78%, the Canadian dollar had hit a bottom around 77.6 cents. 77 cents rather. And what happened? The price continued to rally to the top side steadily. Why? Because the market had bottomed out. So I will also encourage you to come back and read this page again. In fact, read the whole COT data, memorize it, understand it, know how to calculate know how to do the computations and everything, and then master it. Let's now go to the next lesson that says summary market sentiments. So in summary, what have you learned so far? Did you feel excited about those moves? Did Did you feel excited about the moves, okay, and how the COT report correlated with price action? Okay, but it is not just the COT report that you have to consider. Okay, the best thing to do, even while using the COT report, is to backtest and look for reasons why a reversal took place. Was the economy booming? Was it in the middle of a recession? Remember, the COT report measures the sentiment of traders during a specific period of time. So along with other tools in your toolbox, using the COT report as an indicator does not always correlate to the market reversals. Okay, so take your time to study it. And also, before we bring this lesson to a close, as we have been told here, it is always to have in mind, always keep in mind that market prices, they aren't driven solely by COT reports, stochastic, Fibonacci levels, and all that. Markets are driven by millions of people reacting to economic analysis, fundamental reports, politics, Godzilla attacks, UFO fightings, Lady Gaga concert, here and there. Okay, many things make up the market to move up and down. So consider all that we have learned before. But yes, majority, like 50% of the movement of the market, is caused by the commercials, also caused by the non-commercials. So if you include the commercials, non-commercials, and you also add fundamental analysis, oh my goodness, you are almost 80% done. And then by the time you add technical analysis to it, I can assure you, you are good to go. So as forex traders, it's our job to gauge what the market is feeling. Okay, we gauge the market sentiment extreme, and we do this by using COT reports, commitment of traders report. Okay, so by understanding the activities of these three groups of people, the commercials, the non-commercials, and retail traders, we can find ourselves in better positions to fish the tops and bottoms of market. So remember, every market top or bottom is accompanied by a sentiment extreme, but not every sentiment extreme results in the market top or bottom. So with that, I want to say congratulations for having completed the first part of course 7. So please smash the like button, subscribe if you haven't, and until next time, take care.